Fair value gaps are one of the most important yet misunderstood ICT concepts. In this video, I'm going to show you everything you need to know step by step for every single FVG and all the variations of the FVG. So if you're someone who's overwhelmed by all these ICT concepts and all the different names for the FVG, this is the video for you. So let's get straight into the video. Essentially, a fair value gap is made up of 3 consecutive candles, right? So for a bearish example, it's from the low of the first candle to the high of the third candle, and in the second candle, there's basically a gap. So same thing, but for a bullish example, it's the high of the first candle to the low of the third candle. So as you can see, if I drag this out, you can see that there's a gap in the second candle, right? And same here, there's a gap in the second candle for the bullish example as well. And what we can do at this point is mark out the fair value gap that's been created. So now this is the gap in the second candle, and we can expect price to retrace back into this level before continuing lower. Same thing for the bullish example. We can expect price to retrace into this area before continuing in the same bullish direction. Now that we know what a valid FVG looks like, let me show you what an invalid FVG looks like. So as you can see in the first candle, from the first candle's low to the third candle's high, is there a gap in the second candle? If you drag this out, you can see there's no gap. There's actually an overlap of the wicks here. And same for this example, the high of the first candle and the low of the third candle. Is there a gap in the second candle? No, as you can see, the wicks actually overlap. So let's get into some live market examples. Let me show you what a valid fair value gap looks like. However, before we get into the live market examples, if you're trying to pass your funded challenge or you're looking to get funded, then this automated trading bot is for you. Most people spend $8,000 to $9,000 in the space of 4 months before they reach their first funded account. But with this bot, you can avoid this waste of time and money by letting it pass the challenge for you, 100% guaranteed. Our bot does not miss. It passes the challenge usually in a few hours and the same day. So the day after, you could be funded 6 figures, trading live, making real profits. It's a zero risk investment. If you fail the challenge, you get a full refund. However, we've never ever failed the challenge, so you will be funded. That's 100% guaranteed. Get on this whilst it's still available. Click the link in the description to get funded and don't waste time. So now, as you can see in this live market example, price has made 1, 2, 3 consecutive candles. So from the high of the first candle and the low of the third candle, is there a gap in the second candle? And as you can see, yes, there's no wicks overlapping over here, no bodies. So there's a gap. This is a valid FVG. And as you can see, price trades into this fair value gap and then ends up moving higher. Okay, so for this example, again, we've got 3 consecutive candles. The high of the first candle to the low of the third candle. There's a gap in between the second candle, right, on the left and right of it. So now there's no wicks overlapping. This is a valid fair value gap. Let's see how price respects this. So price taps into it instantly, and then, as you can see, moves instantly in the opposite direction. So what's a Bisi and what's a Sibi? A Sibi is a sell-side imbalance, buy-side inefficiency. A Bisi stands for buy-side imbalance, sell-side inefficiency. Basically what this is a bearish fair value gap and a bullish fair value gap. However, with this, you're basically expecting a retrace into it again and for it to carry on in that direction. With an FVG, it can fail, which is still valid. For it to fail, you could be expecting the whole FVG to be filled in. However, you will understand on live charts. Basically for this, again, it's the same thing. We just look for a gap. As you can see, the candles do not overlap. Over here, there's a gap in the second candle, and same thing for this right here. And again, there's a gap in between the second candle. There's no wicks overlapping, right? So it's the same thing, same bearish FVG, bullish FVG example. We expect a retrace for it to go down, and then a retrace into this area for it to go up again, right? So same thing, bearish FVG, bullish FVG, same setup, 3 consecutive candles. Let's get into some live market examples. Okay, so as you can see, 3 consecutive candles. There's a gap between the first candle's low and the third candle's high. Now there's a gap in the second candle, and what we can expect is price to retrace into this and continue down. Price has retraced into that, not closed above, and as you can see, continues down in the direction. Let's get into another example. Okay, so as you can see, now we've got 3 consecutive candles again. First candle's high, third candle's low, gap in the second candle. It's a bullish FVG, it's a bullish buy-side imbalance, sell-side inefficiency. We can expect price to retrace into this area and then carry on. So let's see what price does. It doesn't have to retrace instantly, by the way. It can take a few candles to get there. So as you can see, it's filled that in, and then price moves away to the upside. So let's get into the next fair value gap. Now for the consequent encroachment, or CE. So basically what this is 50% of the fair value gap, right? And the three things that I know when I'm marking out the consequent encroachment is the start of the FVG, 50% of the FVG, which is the actual consequent encroachment, and the end of the FVG. So when the FVG is fully filled, right? And so for this, I've got two examples right here, bearish and bullish. So what I want to see is, as you can see, I've got the Fibonacci tool over here, and this is the 50% marked out right here. And what I want to see is price can tap into this area, which is fine. However, I prefer it if price taps into at least 50%. It taps into the premium area of this fair value gap, right? However, what I don't want to see to invalidate this FVG is price to close above the fair value gap, or even close above and fill it completely. Because usually if it does this, then price is likely to reverse in the opposite direction and it won't be going bearish in this favor. Same example for this, for the bullish example, right? So price can close over here, it can close in this area. However, if price closes beyond 50% or fills it completely, price is likely to actually go in the opposite direction and it won't go in your favor. So let's get into some chart examples. Okay, so as you can see with this bullish fair value gap example, price has made 3 consecutive candles. Remember, the second candle has a gap in between. All I've done is marked out 50% of this fair value gap, and price can tap into this area over here. Price can tap into the upper half. It doesn't have to touch the 50%. However, if it does touch 50%, it's a high probability setup. So let's see what price does. And remember, if it fills in the FVG completely, that's fine with a wick as well. However, if it closes below the full FVG, chances are that the trade won't go in your direction and the fair value gap price won't be going bullish anymore. Price can actually reverse. So let's see what price does. Okay, it's tapped into this area, so it's a valid trade. As you can see, it's getting close to the 50%. However, price ends up running away, which is completely fine. Price can run away without touching the 50%. The 50% is just a refinement. Okay, so for this example, again, bullish fair value gap, and we've got some buy-side liquidity resting above these highs over here. So all I've done again is just marked out 50% of this fair value gap, and let's see if price taps into this area. Okay, so as you can see, price immediately touches it. It closes within the upper half of it, so it closes within the start of it. However, it doesn't close below 50%, so the FVG is still valid. And now, as you can see, price moves away instantly from this area. Okay, so the next type of fair value gap, an inversion FVG. And essentially what this inversion FVG is a failed fair value gap. So what happens is price closes through and fills the FVG completely. So remember, the highest point, the extreme point, was a fill point. Price actually closes through and invalidates this bearish fair value gap. However, it can be used inversely as a support or resistance, depending on which fair value gap you're using. So again, you can mark out, for this bearish example, you can mark out the consequent encroachment, and then you could expect price to tap into this area over here before moving up. And again, with this example, you can mark out 50% again and expect price to tap into the inversion fair value gap this time and then move down. And another thing is, it doesn't have to happen instantly, like back to back. So basically, it can take time. It can take time to close. You don't have to just close below with just one candle and create a fair value gap here. No, it can take multiple candles and then close below and then find a retrace into it and then drop down. But we're going to get in some examples, so don't be confused. Okay, so for this example will fake a lot of you guys out and you'll miss the inversion FVG. So I'm going to show you the right way to trade it. So let's get into it. 3 consecutive candles. As you can see, there's a bearish FVG formed right here. And let's see what happens to this fair value gap. Remember, this is the fill point, this is the extreme point. So if price closes above this point and closes through it, then this FVG is invalidated. However, a lot of people will think that to invalidate an FVG, price has to move fully above this market structure shift high, which is not true, right? At this point, the fair value gap, this bearish fair value gap is now invalid. So now we can use it as an inversion fair value gap. And in confluence with this, you can mark out the consequent encroachment again, just 50% of it. And then we could expect a retrace into this area, but to go higher, possibly attack these buy side liquidity. So let's see what happens. Get rid of this. Okay, as you can see, price taps into it. Does it close below? Okay, we've got some wicks through it. However, it did not close below and close through it, so it's still valid. And then, as you can see, price moves away nicely. Let's get into another example. Okay, so as you can see, we've got another bearish fair value gap, but let's see what happens to this bearish fair value gap, right? Because we want to see it used as a inversion FVG, so confidence to use it as an confluence to know that it's going to fail, and it can be used as an inversion FVG. You could say sell side being taken out here, so price could possibly reverse in the opposite direction. So let's see what happens. Okay, is it validated now? The answer is no, because price hasn't closed above the extreme. It hasn't filled it fully. It hasn't closed through it. So not an inversion FVG just yet. However, as you can see, it closed beyond 50% over here, which I explained at the start with the consequent encroachment. If it closed above 50%, it's a high probability that the trade won't work out as a bearish FVG. So that was a sign that this FVG was going to fail, right? So now what you could do is, because price has closed above it completely, you could expect a retrace into this area for continuing, right? And as you can see, this wasn't just instant retrace into it. Price took some time, wicked into that 50% nicely. Let's see how it closes. Okay, as you can see, it's still not closed below this extreme, right? So it's still valid. The whole trade is completely valid right now, the whole FVG. And then as you can see, price completely flies to the upside. A fair value gap is made up of 3 consecutive candles. However, the difference between a volume imbalance and a gap and a fair value gap is that the volume imbalance is made up of 2 candles and solves the gap. So a volume imbalance is the gap between the opening of the first candle, or the closing of the first candle, and the opening of the second candle. But the difference between the volume balance and the gap is that there's completely an absence of trading with the gap. However, with the volume imbalance, the wicks can actually overlap. So as you can see, the wicks, the low of the first candle is overlapping with the high over here. And however, with the gap, the low of the first candle is not overlapping at all. So it's literally in the name, it's a complete gap. However, with the volume imbalance, you just mark it out from body to body, and it's just vice versa for a bullish example. So let's get in some live examples. So as you can see, with these 2 candles right here, we've got the close of the first candle to the open of the second candle, and as you can see, the wicks are overlapping, yes, so there's not a complete absence, so it's not a gap. In this case, it's a volume imbalance, right? So if we let price play on, you see price taps into this area nicely, wicks into this area nicely, and then flies in the opposite direction. Another example is here. So you've got 2 consecutive candles, the close of the first candle to the opening of the second candle, and let's see how price treats this area. Remember, it doesn't have to retrace instantly, it can take a while to get there. As you can see, price wicks into that area nicely and ends up moving to the upside nicely. Let's get into the gap example. So as you can see, the gap is not hard to spot. You can see there's a complete absence of trading, so 2 consecutive candles. The wicks don't overlap, so the high and low of each candle do not overlap. And you can mark out the opening and close. However, the correct way to mark the gap out is actually to mark the full gap. So as you can see, there's no trading in this area between these 2 candles. So you can expect price to retrace into this area, and we'll have some sort of reaction from here. So that's it for today's video. That's all the fair value gaps and all the variations of each gap explained. And just a reminder, if you're struggling to get funded, this automated trading bot will pass the challenge for you. We had people buy the service yesterday, and now they're funded over 6 figures, right? $200,000 account. Let me just show you right here. So another trader was funded $100,000 after using the service yesterday, and in a day they were funded. And another client was funded $200,000 within 5 hours of trading. And most people take weeks overpassing these challenges, and then they end up failing. So if you want to get funded, click the first link in the description below, and it's a guaranteed pass, a 0 risk investment. If you fail the challenge, you get all your money back, no questions asked. However, we've never ever failed a challenge, so you will be funded. We will pass the account. It's 100% guaranteed. Click the link in the description to get funded. And that's all for today's video, guys. I hope you found this insightful. Drop a comment in the comment section down below. Drop a like, subscribe, and share the video with a friend who's struggling. See you next time. Peace.